With recent rate volatility, there has been the need to stay nimble. And most recently, we've seen a rise in treasuries, which has caused some of our fixed rate strategies to not really work. So, most recently, on our deal called Grand Riviera, which is a 206 unit deal in Dallas that we're currently under contract on, we had switched to a bridge loan because with the way that fixed rates were rising, there was almost not parity, but the attractiveness of locking in a fixed rate really wasn't there. Now, compared to a bridge loan, yes, a bridge loan is more expensive, but you get the flexibility, so you're not married to that rate, and hopefully you get the benefit of rates floating down as the Fed starts cutting, and then you also, of course, have the flexibility to be able to then refi into a better debt structure or even sell opportunistically if the market bounces back. So those are the pros of a bridge loan, but like I said, bridge loans are expensive. Roughly speaking, SOFR today is 5.3%, and bridge loan spreads are around 3.5%. So you do the math, that's upper eights and into the nines for a lot of debt products. Now, of course, SOFR at 5.3%, that's not here to stay. We all know that the Fed is going to cut rates. It's not a matter of if, but a matter of when. But that doesn't mean it's going to just magically fix all your problems. I don't think the Fed's cutting SOFR down to zero anytime soon. So if you kind of plug in your best guess and you think, well, I think SOFR is going to average, let's say, 4% over the next 3 years, then if you add a 3.5% spread on that, that's 7.5% of an all-in rate. So that's just something to keep in mind when you're evaluating bridge loans. You know, there's a lot of, I want to say, complexity around bridge loans, but also more so uncertainty, because if you have a floating rate, you just really don't know what that rate is. You know what your starting rate is, and you can obviously model out the future path of rates through a forward curve, but that uncertainty is there. The other thing that kind of confuses people is rate caps. And so people are buying deep in the money rate caps to create a synthetic fixed rate on their bridge loan. And they're saying, well, our bridge loan's only 5.5%, or it's a 5.25%. But that's not true. You just prepaid interest essentially through the purchase of an interest rate cap at closing. So that's a topic for another video. We've talked about on the podcast as well, but definitely something that remains popular today. But what I really want to share with you is the latest pivot and creative move that we're making on Grand Riviera, which is we've pivoted away from the bridge loan because we've discovered, especially now that fixed rates have come down just a touch, we've now figured out that a combination of a lower leverage senior loan coupled with a preferred equity tranche gets us everything we want from a bridge loan and more. So the way that that works is we get a fixed rate of around, call it 6 to 6.25% on the senior loan. And just to use simple math, let's say it's a $20 million loan. And then the preferred equity tranche is $4 million. So a total debt stack of $24 million, which equals exactly the amount of debt that we were going to get on a bridge loan. So leverage is the same on the bridge versus the senior plus pref combo. Now, the senior costs about 6.25%, we'll say. And the the preferred equity costs 6% current pay and 7.5% accrued. So if you're not familiar with preferred equity, you'll hear those current pay versus accrual, those words thrown around. And so what that means is a preferred equity lender is expected to get paid that 6% every single month. And then they're accruing on a simple interest basis the remaining portion of their total interest. So basically, the preferred equity lender is looking to make a total of 13.5%, the 6 plus 7.5 for 13.5%. But they only need to get paid that 6% on a monthly basis. So if you look at your kind of your cost burden or your interest expense on a monthly basis, it's the senior loan at 6.25%, and then it's the $4 million pref piece at 6%. And so if you blend that, you get to a blended current cost of capital there of 6.2%. Now, that already is great because that's cheaper than a bridge loan where your starting rate is around 9%. So that's helpful there from a current expense perspective. But obviously, you have to factor in that all-in cost of the pref because of that accrual rate. So if you take the weighted average cost of capital and you blend the senior plus the pref, you take the 6.25 rate on the senior and you take the essentially 13.5% rate on the pref, that blends out to about 7.65%. So that is your fixed cost of capital on that debt combination. Now, of course, that kind of roughly is in line with the cost of the bridge loan at 7.5% if you average out, if you assume that SOFR is going to average 4% over the next 3 years, which could turn out to be an aggressive assumption or it could turn out to be right. So, but having a fixed cost to your debt is always an advantage. But usually the downside of having a fixed interest rate is you get locked into onerous prepayment penalties. And so that's the beauty of this contemplated debt structure is we actually have a buy down on the prepayment penalty on the senior loan, and then the preferred equity loan has a flexible prepayment as well. So we can still retain the flexibility as if we were using a bridge loan to sell a refi in about 24 to 36 months to hopefully take advantage of our successful business plan and generate a profitable exit for investors. So to recap the advantages of the senior debt plus preferred equity combination, you get the same amount of debt proceeds as the bridge product, you lower your cost of capital, and you retain the flexibility that you're originally looking for from the bridge loan, while of course having a fixed interest rate instead of floating rate. So I know this was a little bit more in the weeds, more complicated, but I think this is super important. If you can wrap your mind around these enhancements to the deal, it really makes it a no-brainer. So if you're looking to learn more about what we do at Lone Star Capital or specifically invest in this Grand Riviera opportunity in Dallas, Texas, please reach out to us today.